Hello everyone, welcome to Zen Go. I'm Vincent. Today we're talking about someone who might just be the best moneymaker on the planet. While the whole world was panicking over stock market crashes, he was quietly counting his cash. While tech stocks were crying in despair, his company's stock price was actually rising against the tide. This man is Warren Buffett, the legendary investor known as the Oracle of Omaha. In 2025, the US stock market went through absolute carnage. The S&P 500 plummeted with a maximum drop of 18.9%, while the Nasdaq crashed even harder at 23.87%. Tech stocks got hammered, and countless investors lost big time. But in the midst of all this despair, one company's stock price was actually climbing higher: Berkshire Hathaway. Why? Because Buffett had been preparing for this all along. By the end of 2024, Berkshire Hathaway's cash and cash equivalents had reached a staggering $334.2 billion, representing a historic high percentage of total assets. This 94-year-old man was telling the world through his actions, the storm is coming. This wasn't the first time Buffett showed incredible foresight. Looking back at history, we find an interesting pattern. Whenever Buffett starts hoarding massive amounts of cash, a market crisis isn't far behind. In 1998, during the dot-com bubble, his cash reserves hit new highs. In 2005, just before the subprime crisis, he was hoarding cash again. In 2020, when COVID and oil price collapses triggered global financial panic, his cash reserves were at another peak. Buffett has a famous saying, "Be fearful when others are greedy, and greedy when others are fearful." This isn't some sophisticated investment technique. It's an insight into human nature. Most people get carried away when markets rise, and panic when they fall. But true investment masters stay calm when everyone's celebrating and dare to act when everyone's in despair. On August 30, 1930, a premature baby was born in Omaha, Nebraska. This little guy, weighing just 5 pounds 4 ounces, would become Warren Buffett. His birth timing was incredibly coincidental, right during the Great Depression following the stock market crash. Maybe fate destined him to leave a major mark on stock market history. Buffett's father, Howard, was originally a stockbroker at a bank, but lost his job during the economic crisis. To support his family, Howard used his meager savings to start a stock brokerage firm with a few friends. Strangely enough, the company quickly became profitable, and their family life improved from then on. From childhood, Buffett showed an intense interest in money. His favourite toy was a piggy bank, and his favourite games all involved numbers. At age 7, while other kids were reading fairy tales, Buffett was checking out 1,000 ways to make $1,000 from the library. At 10, when his father took him to New York, he didn't ask to visit amusement parks or zoos. He wanted to tour the New York Stock Exchange. At 11, Buffett convinced his sister Doris to pool their allowance money, and together they bought their first stock, Citi's Service Company, at $38.25 per share. This was an all-in investment. They put every penny of their savings into it. The stock price immediately dropped to 27, and Buffett got reamed out by his sister. Fortunately, the price quickly bounced back to 40, and Buffett immediately took profits. But who knew this stock would later rise to 202? This small investment experience gave Buffett several important insights. First, the cost of buying stocks doesn't matter. What matters is growth potential. Second, short-term small gains don't matter. What matters is long-term returns. Third, when investing, you must trust your own judgment and not be influenced by outside noise. After high school, Buffett wanted to start a business right away, but his father refused. In 1947, 17-year-old Buffett entered the Wharton School at the University of Pennsylvania, later transferring to the University of Nebraska-Lincoln, where he earned his Bachelor of Business Administration degree at 19. By then, he already had $9,800 in savings, equivalent to about $500,000 in today's purchasing power. After college, Buffett wanted to continue his studies and applied to Harvard Business School, but was rejected. In 1959, he learned that Benjamin Graham, the father of securities analysis, was teaching at Columbia Business School, so he decided to apply there and was successfully accepted. Graham was born in London to a Jewish family in 1894 and moved to New York as an infant. After graduating from Columbia University in 1914, he became a securities analyst on Wall Street. In 1923, he independently founded Graham Newman Partnership, equivalent to today's private equity fund. Starting in 1928, Graham began writing and teaching securities analysis courses at Columbia University. Graham's contribution was transforming stock trading from a game dependent on intuition, luck, and insider information into a science with logical support and calculable results. He created the field of securities analysis. During his master's studies at Columbia, Graham was Buffett's mentor. Graham had over 20 students at the time, most older than Buffett. According to classmates' recollections, Buffett was probably the youngest student in class, but undoubtedly the most precocious. He seemed to know all the answers and was always enthusiastic, talking more than others. Because he had thoroughly read his mentor's works, Buffett could engage in deeper discussions with Graham. In class, when other students were still confused, only Buffett was having heated discussions with Graham. The entire classroom became a performance by two people. After his master's degree, Buffett first joined his father's brokerage firm as a stock salesman, but with his elite background, Buffett was destined not to stay in this position long. It would be like having a top graduate from Tsinghua University's finance program work as an insurance salesman. After 2 years of experience, Buffett finally had the opportunity to join his mentor Graham's company to do real investment work. From then on, in the ever-changing financial world, Buffett officially began his journey to becoming the Oracle of Omaha. Graham's value investing theory can be summarized with 3 core concepts: intrinsic value, margin of safety, and Mr. Market. Graham believed that stock prices fluctuate around intrinsic value and will return to intrinsic value in the long run. When stock prices are below intrinsic value, investment opportunities appear. The difference between stock price and intrinsic value is the margin of safety. Graham personified the stock market as Mr. Market. Mr. Market's emotions are very unstable, cyclical, and contagious. Sometimes he's very optimistic, offering high prices. Sometimes he's quite depressed, only seeing immediate difficulties, and therefore offering low prices. How do you determine if a company's intrinsic value is underestimated? Graham used a simple analogy. You buy a used computer for $50, take it apart, and find the parts inside can sell for $70. You've made money. Or a brewery might be valued at $1 million, but you discover the beer in the warehouse is worth $1.5 million when sold. That's also profitable. Buffett used cigar butts to describe undervalued stocks in the market. This investment method was vividly called cigar butt picking, looking for those cigar butts discarded on the ground that no one cares about. If there's still enough value for one more puff, buy them at the lowest price, extract the remaining value, and profit. Using the cigar butt picking method, Buffett accumulated $170,000 in 2 years. Mind you, his family's annual expenses were only $12,000 at the time. In 1956, Graham retired and closed his company. The ambitious Buffett returned to his hometown of Omaha, gathered investors, and founded his own investment company, Buffett Partnership Limited, beginning his independent investment journey. One evening in 1957, Buffett visited Dr. Edwin Davis, the town's famous urologist, hoping to get $100 investment. Buffett talked enthusiastically, but Davis listened absent-mindedly. Finally, Davis said expressionlessly, "I need to discuss this with my wife." Buffett thought this was a polite rejection and was about to leave. Unexpectedly, after whispering with his wife, Davis said he wanted to invest $100,000. Seeing Buffett's confused expression, Davis said, "Because you remind me of someone, Charlie Munger. You two are so alike." This was the first time Buffett heard Munger's name. It wasn't until 2 years later that Buffett actually met Munger. In 1959, when Munger's father died, he returned to his hometown of Omaha for the funeral. Through an introduction by Dr. Davis's son, he met Buffett. Charlie Munger was born in 1924, 6 years older than Buffett. Their childhood homes were only a few hundred feet apart, but they had never met. Munger's grandfather was a federal district judge, and his father was a successful lawyer. His privileged family background allowed Munger to live comfortably even during the Great Depression. At 17, Munger entered the University of Michigan to study mathematics. But that year, Japan attacked Pearl Harbor, and Munger resolutely enlisted, becoming a military meteorologist. After the war, Munger entered Harvard Law School, and after graduation, like his father, became a lawyer, settling in Los Angeles. In 1959, when Munger returned home for his father's funeral, Dr. Davis's son booked a restaurant and invited many friends, including Buffett and Munger. The two hit it off immediately, talking so much that others couldn't get a word in. The next day, they met again at a friend's house and still had endless things to talk about. Buffett was very proud of his intelligence and investment ability and never respected anyone, but he alone felt that Munger was smarter than him. Years later, Buffett said, "Because of Charlie, I became better. This man, through the power of his thinking, expanded my business and allowed me to evolve from ape to human at extraordinary speed. Otherwise, I would be much poorer than I am now." Under Munger's inspiration, Buffett innovated Graham's value investing one version. Munger told Buffett he shouldn't always look for cheap, ordinary companies, but should buy good companies at reasonable prices. Buffett thought Munger had great investment talent and suggested he could pursue investment as a side business alongside his legal practice. Later, the side income far exceeded his main profession, and Munger completely left the legal industry to focus on investing. In 1962, Munger partnered to establish the securities firm Wheeler, Munger Co. By 1972, the company had achieved an average annual return of 28.3% over 11 years. But In the subsequent 1973-74 US stock crash, Munger's company suffered heavy losses, almost losing half of the previous 11 years' profits. Fortunately, Munger withstood the pressure and held on to his stocks. Finally, in 1975, he saw profits rebound. After experiencing this wealth roller coaster, Munger realized there was no need to go it alone anymore. In 1975, he liquidated his partnership and invested the funds in Buffett's Berkshire Hathaway, officially beginning his collaboration with Buffett. From their first meeting in 1959 to Munger's death on November 28, 2023, Buffett and Munger were the closest friends and partners for 64 years. After Munger joined, Buffett's catchphrase when speaking became Charlie and I. The media often used the pair to describe them. They collaborated for more than half a century and never had a single argument. Whenever there were disagreements, Munger often ended the conversation with this phrase, "Buffett, if you think about it carefully, you'll agree with me because you're smart and I'm right." Munger's addition completely changed Buffett's investment approach. Under Munger's influence, Buffett's value investing 2 era arrived. The upgraded value investing theory included 3 steps. First, find good companies. Second, buy at reasonable prices. Third, hold for the long term. Buffett called this investment method snowballing. He said, "Life is like rolling a snowball. The most important thing is finding wet snow and a long slope. Leave the rest to time. As time passes, the snowball gets bigger and bigger." This is the magic of compound interest. In January 1972, Berkshire Hathaway's subsidiary Blue Chip Stamps acquired See's Candies. This was one of the most important investment decisions in Buffett's life. In a sense, you could even say See's Candies made Buffett, because it was through See's Candies that Buffett first practiced the transition from cigar butt picking to snowballing investing. See's Candies was founded in 1921. That year, Charles See and his mother, Mary See, opened the first See's Candy store in Pasadena, California. Mary had 50 years of candy-making experience and exclusive recipes, while Charles had managed chain candy stores in Canada through 2 generations' efforts. See's Candies flourished in California. When Buffett acquired See's Candies, its net asset value was estimated at about $7-8 million, but See's was asking for $30 million. Although Buffett eventually negotiated the price down to $25 million, buying a company at 3 to 4 times net assets would have been crazy by cigar butt picking standards. Just when Buffett was hesitating, Munger convinced him, buying good companies at reasonable prices is more suitable for the current era. Good companies generate profits and free cash flow that can be used to buy more good companies, which then generate more profits and free cash flow, creating a virtuous cycle. Facts proved Munger's judgment was correct. See's Candies' investment returns were like a perpetual motion machine, continuous and never-ending. Although the candy industry grew extremely slowly, with very small new market increments each year, this also meant that big brands like See's could form quasi-monopoly effects. New brands found it very difficult to compete with See's. Speaking of Oracle Buffett, what's his favourite beverage? Many people can easily answer Coca-Cola. It's said that Buffett doesn't drink coffee or alcohol, but drinks 5 cans of Coca-Cola every day. From age 6, Buffett had a special fondness for Coca-Cola. On October 19, 1900, 987. The Dow Jones Industrial Average plummeted, with a daily drop of 22.6%. Coca-Cola's stock price also fell about 20%. The first year's stock market crash caused Coca-Cola's stock price to drop from a high of 53 to 29 before rebounding. Buffett began buying large amounts of Coca-Cola stock, starting in late 1988. Why didn't Buffett start buying when Coca-Cola's stock price was at its lowest in 1987? Did he misjudge market conditions? Of course not. This also related to an admitted mistake in a new product experiment by Coca-Cola in 1988. In 1985, Coca-Cola invested tens of millions of dollars to develop a new product, Cherry Coke. In almost all blind taste tests, the new Coke was rated superior to traditional Coke. But just as Coca-Cola chairman Roberto Goizueta began heavily promoting the new product, consumer complaints flooded in like snowflakes every day. People strongly expressed shock and anger at Coca-Cola changing its taste. Some customers even claimed that changing Coca-Cola's taste was as unacceptable as rewriting the Bible. Under pressure, at the end of 1988, Coca-Cola announced it was abandoning promotion of New Coke and refocusing on Coca-Cola Classic. It was this New Coke versus Old Coke controversy that made Buffett realize that even with credible evidence that substitute products were of better quality, they couldn't replace Coca-Cola's position in Americans' hearts and wouldn't damage Coca-Cola's competitiveness. After confirming Coca-Cola's unbeatable investment value, Buffett began buying. By 1989, Berkshire Hathaway had acquired 23.35 million shares of Coca-Cola stock, about 6.9% of Coca-Cola's total shares. The cumulative investment was about $1.024 billion, accounting for 30% of Berkshire Hathaway's net assets at the time. Today, Berkshire Hathaway's stake in Coca-Cola has reached 9.29%, making it Coca-Cola's largest shareholder. Just from dividend income alone, Buffett receives $700 million annually from Coca-Cola. What's that concept? It's roughly equivalent to winning a 5 million lottery jackpot every day for 2 consecutive years. Can Buffett's investment wisdom be replicated? Is it outdated in the new era? First, whether it's Graham's value investing 1 or Buffett's value investing 2, stock selection depends on company valuation. However, valuation really isn't simple at all. Cash flow, balance sheets, annual reports, even field research. These are all very superficial things. Take the See's Candies investment as an example. What ultimately made Buffett decide to buy wasn't See's Candies' book value, but its intangible value based on reputation, products, and competitiveness. Second, Buffett's long-term holding itself is very counterintuitive. For example, Buffett has held Coca-Cola for 34 years, BYD for 14 years, and Apple for 8 years. These stocks experienced countless market fluctuations during this period. From 1998 to 2008, known as Coca-Cola's lost decade, its stock price once evaporated nearly 40%. BYD was even more dramatic, with its stock price plummeting from HK 78.5 in October 2009 to just over HK 6 in September 2011. Who could have imagined then that BYD's stock price would rise to HK 400 today. More importantly, Buffett succeeded in a long-term rising market. The Nasdaq index rose from the 200, 300 points in the 1980s to around 17,000 today. The S&P 500 rose from around 780 points in the 1990s to around 6,000 today. If Buffett came to China's A-share market, which has stayed around 3,000 points for years, his value investing theory might suffer serious blows. However, this doesn't mean Buffett's investment philosophy is meaningless for ordinary people. Buffett often says, "Be fearful when others are greedy, and greedy when others are fearful." This is actually the essence of investing. In the stock market, the more experienced investors become, the more deeply they understand one truth. Investing must be counterintuitive, or success is impossible. Buffett's value investing system has another, very important principle, the circle of competence. He says, if you know the boundaries of your competence, you'll be much wealthier than those whose circle of competence is 5 times larger than yours, but who don't know the boundaries. You don't need to be an expert on every company. You just need to be able to evaluate a few companies within your circle of competence. But at the same time, you need to continuously learn new knowledge and new fields to maintain progress. As Buffett said in a 2019 interview with Andy Serwer, the best investment is actually investing in yourself. This might be the most useful advice Buffett left for ordinary people. In a world full of uncertainty, Buffett has used nearly a century of investment career to tell us true wealth comes from patience, rationality, and persistence in value. No matter how markets fluctuate, no matter how technology develops, human greed and fear will never change. Those who can stay clear-headed when everyone is crazy and maintain confidence when everyone is in despair are the real winners. Alright, that's all for today's sharing. If you found this episode helpful, remember to like and subscribe. See you next time.